Well, hello again, and will be the last go around for these videos, which I'm sure will not break a lot of hearts. This is chapter 13, and so in this chapter, it's kind of a capstone. We're going to take a look at some more advanced stuff, kind of a glimpse or a sneak preview into what you would get into more in future accounting courses if you choose to take them. And then there's some review as well, getting into a little bit more depth on things like financial ratios. So it's a nice mix. It's a good way to wrap things up, I think. So on slide 3, we have the objectives for this chapter. And as I said, we've covered some financial ratios as we've gone along, and we'll get into those in this chapter as well, maybe a couple of new ones. And we'll also discuss other types of analysis, such as horizontal and vertical, and what these do for us. And here on slide 4, here's the organization chart presentation of the chapter objectives. And note the new topics of sustainable income and quality of earnings as we take a deeper dive into the financial statements. And on slide 5, sustainable income is net income adjusted for what is called irregular items. That is, items that are not usually a part of regular income. The two types by their titles are not regular in nature. Discontinued operations, which we would hope rarely happens if ever to a business, and extraordinary items, the title would suggest it's not common at all. Note that such items are reported net of their income tax effects. And there is a reason for that, which we'll get into a little bit later. And my cat just seems to love the limelight. Of course, he's probably going to jump up into that window behind me there, which he seems to love. Okay, so we're on slide 6. Here's an example of an income statement with the various components leading to the bottom line. And notice here for now where the discontinued operations and the extraordinary items fit into the picture as far as the order of presentation. Later we'll discuss other comprehensive income items as well. On slide 7, note that the term discontinued operations has to do with a significant component of a business, not a small potatoes operation. The disposal will normally involve either a gain or a loss, which is the difference between whatever the company received for the disposed assets less their book value. Then on the income statement, this item is presented as a gain or loss, again net of the income tax impact. On slide 8, here's an illustration of accounting for a discontinued operation in the income statement. In this case, the unprofitable chemical division was the discontinued operation and was sold at a net loss of $210,000. Notice that this amount was net of the tax savings of $90,000 on the loss. Note also its presentation in the income statement after income before irregular items. On slide 9, extraordinary items are just that, very unusual and very infrequent. In making this determination, the company must consider the environment in which it operates. In other words, a transaction that may be very unusual in one line of business may not be so unusual in another. Again, the transaction or transactions must be reported net of their tax impact, since they are reported on the income statement after net income, which is also net of taxes. So there you go as to the rationale for doing it this way. On slide 10, this illustration is shown fully on page 688 of the text. In this example, since the loss on losing the property is $70,000, but the positive tax effect, that is tax savings, is $21,000, the net amount to be shown for the extraordinary item is negative $49,000. So that is 70 minus 21. Note the description of the extraordinary item provided in the partial income statement shown on page 688. Such a description should be provided for each extraordinary item, either in the income statement itself or in accompanying notes. Since the net loss amount is $49,000, this means that the bottom line net income is now $301,000. That is 560 minus 210 minus 49. Let's take the examples on this slide 11, one by one. First, the effect of a major natural casualty certainly qualifies if it is not a frequent occurrence in the area of business in question. For example, if we were talking about hurricanes in Florida, that might not necessarily be an extraordinary item for a business that operates on the Florida coast. Excuse me. Second, if the major natural casualty is in an area where this is not uncommon, and again, say hurricane damage on the southeastern seaboard of the U.S., this would not be considered an extraordinary item, although it could still be discussed in the notes to the financial statements if thought to be significant. Third, a write-down of inventories or receivables is not uncommon for businesses in general, so it would not be considered extraordinary. Fourth, takeover by expropriation of property by a foreign government is not only egregious, but hopefully unusual and infrequent. Therefore, such instances are considered extraordinary. Now, on slide 12, here are some more examples, and I think you can see why they are considered as they are. The two no items are not unusual or necessarily infrequent. Measuring the impact of a new law or regulation may not be that easy, but this is talking again about something unusual that is not expected to recur, and that obviously has a direct impact on the business in question, such as the condemnation example cited in the text. Now on slide 13, as this vignette shown on page 689 points out, there needs to be careful analysis of so-called non-recurring charges to ensure that they are indeed non-recurring in nature. There is the matter of what a large one-time non-recurring charge or expense does to reduce the net income for the period, as explained on page 742. Excuse me, and maybe that's why some companies spread these charges over several periods to smooth out that impact, whether or not it's legitimate to do so. On slide 14, when a company wishes to change an accounting principle used, they must report this change and also show the impact retroactively. One of the most common changes in principle is changing how inventories are accounted for, say from FIFO to average cost as mentioned on the slide. Now on slide 15, we switch over to comprehensive income. And comprehensive income goes beyond the net income from operations, discontinued operations, and extraordinary items, and includes certain gains and losses that otherwise would not show up on the income statement because they are direct adjustments to stockholders' equity. And an example that's shown on the slide is an unrealized gain or loss on available for sale securities. A little bit of a distinction there by calling this only for available for sale securities. And an unrealized gain or loss obviously is still just on paper, haven't actually experienced it yet, but it does need to be accounted for. And on slide 16, one of the most typical OCI or other comprehensive income adjustments is for market value gains or losses from investments. An example of such is shown on this slide, where we have an unrealized or paper loss of $2,000 on the investment stock held. The question is, how is this to be accounted for, if at all? And on slide 17, as you can see, the answer is it depends, like the lawyers often say, and on what the purpose of the investment is. If the purpose is trading, then the unrealized loss goes to the income statement. If the purpose is to sell, then the unrealized loss is a direct adjustment to stockholders' equity. So again, we need to make that distinction. Now on slide 18, here is the illustration if it is a trading security. The loss goes to the income statement, as shown here. And notice that the bottom line is now called comprehensive income instead of net income. Now on slide 19, here's the illustration if the stock is available for sale. The loss is then a direct adjustment in the stockholders' equity statement or the stockholders' equity section of the balance sheet, as shown on this slide. And on slide 20, here's an illustration of a complete income statement showing the effect of all of the irregular items that have been discussed thus far, and is shown on page 892 of the text. Note again the order of presentation. First, discontinued operations. Second, extraordinary items. 3, net income. 4, unrealized gain or loss on available for sale of securities. And 5, comprehensive income. On slide 21, this do-it example is shown on pages 692 and 3 of the text. And note how the 30% tax rate was used to compute the net of tax amounts for the extraordinary loss and the loss on the disposal of a business unit. The extraordinary loss can be computed as 100,000 times 30% for 30,000 in tax savings, and therefore the net loss is $70,000. The loss on the disposal of the business unit, 140,000 times 30%, equals a $42,000 tax savings. Therefore the net loss is 140 minus 42, or 98,000. Therefore the net income is 112,000. 400,000 minus 120 minus 98 minus 70. I guess if we were actually in class, I'd be asking if there were any questions at this point. Hopefully you'll have them on the discussion board if you do. Slide 22. Now we move into the comparative analysis of companies' financial information. As can be seen, the comparison base may vary, be internal or external, and the tools for analysis are numerous as well. And we'll touch upon a lot of these in the remainder of the chapter. On slide 23, horizontal analysis compares like accounts over a period of time. For example, what's happened to accounts payable balances over the last 5 years. This is also called trend analysis because by using it we can see if there is a positive or negative trend in an account balance over time, such as accounts payable. As noted in the slide, this type of analysis is normally applied to income statement and balance sheet accounts. And on slide 24, here's an illustration of horizontal analysis that is shown on page 695. Note that the differences between years are expressed both in dollar amounts and in percentages, which is the recommended way to do the analysis so that both perspectives are captured. Note, for example, the large percentage increase in the common stock account of 24.2%, yet the amount of increase is not that great compared to some of the increases in other accounts, because the common stock account is not that great of a total in relation to a lot of the other accounts either. Well, with that, we'll wrap up this part of the presentation.